All right. Yes, perfect. So, first of all, we are coming to an end for this enrollment month, for the original enrollment month, meaning that the analyst, the execution, psychology, MMP week, the 4 original weeks right there are coming to an end. And afterwards, we have the 5th week, which is sort of like an extra, you could see it, where we go over the finishing touch. And the finishing touch means that we go over feedback, we go over questions, something was unclear, etc. That is exactly the videos we can make in that week. And that is what we'll do in the coming weeks as well to clear any confusion. That's very important. Now, in the end, what do we actually do? Because where do we go from here? Well, first of all, it's understanding as well. If this is your absolute first enrollment, then you have just learned pretty much the basics, I would say, because we have gone into a lot of details, which is already very advanced, but likely the details do not stick with you the first time. If you get to know candle signs, then the first thing that actually sticks with you is likely the word candle signs, right? It's not exactly respect, disrespect, what do we do, when do we disrespect? No, the first thing that actually sticks to you is candle signs. Or if we talk about it another time, then the next thing can be remembered. So the more times you watch it, the more thing you'll remember in a certain video as well. And it's the same for a particular enrollment, where in an enrollment and after an enrollment, that's perfect. That doesn't mean we end. That's the beginning. Because right now we've been introduced to the videos. So we know the names of the videos. We have a rough idea of what we need to do in those videos, what we can expect. Now we watch it again to notice the details. And then after we watch it again. How do we get to know those details ourselves? How can we actually apply those details? So that is exactly our goal, where watching it one time is not enough in my opinion, and we need to watch it over and over and over. And it's the same with reading a book. It's always advised to read a book multiple times and to reread it after a couple of months, after a couple of years potentially, because you'll pick up on new things over and over and over and over. And that is very important. So on the left side of my screen and on the left side of your screen, you are seeing my Notion. And in my Notion, this is usually where I create my cheat sheets to go over what I actually want to talk about in those videos, where I prepare the videos. And right there, I prepared the video with a few bullet points that I want to go over. So the first thing I wrote down was I want to go over everything. And the video is called The End. It sounds pretty dramatic, but it's not. Because I want to go over everything right here. I want to go over again and remind ourselves, what do we need to do? Where do we need to use those different concepts? Why did we go over that video? What was the purpose of that video? That is what I want to go over in here. Now, these concepts fit into the foundation levels. They each have their own purpose. Where, for example, order flow, of course, is basically everything. As in, it fits into your bias, narrative, boundary, target, entry plan, and risk range. It's basically everything. So here we build a story that we can use according to those foundation levels. And again, don't underestimate the importance of those foundation levels, because what you have achieved and what I hope you have achieved by this enrollment, if this is your first time watching the enrollment, then I hope you have achieved the understanding of the foundational levels. What do we need to do for bias? What do we need to do for narrative? What is that boundary? What is that context, that target? What is that entry pattern? What is that risk management? Then after that, we can slowly look to add those details again. So currently we just got familiar with everything, where of course we already went into the details in the video, but likely you did not pick it up fully. Where if you watch it again, you'll pick it up more and more and more. Where I know members that have watched previous enrollments 4 times. 4 times. And then I like, every time I watch it, Ario, I pick up a new thing. And that's crazy. That's exactly the goal as well. That is beautiful for me to see. And I say crazy in a positive term. So the first video we started off with was PD race. And in that video, we also introduced the foundational levels, where we went over the bias, the narrative, boundary, target, entry pattern, and risk management. In the analyst phase, we focused on the first 4 foundational levels. That is bias. What is bias again? Bias is that direction, right? Bullish or bearish. It's that draw on liquidity. Draw on liquidity meaning that draw on liquidity is we're always reaching for a PD rate, so premium or discount rate. If we have bullish bias, we are targeting a premium rate. If we have a bearish bias, we are targeting a discount rate. Again, all things that I'm mentioning here is all things we've already gone over. So if it sounds new to you, then likely that is because the information at that moment in time was quite overwhelming, where I mentioned if we go over a video and that video's name is PDRace, then all the things mentioned in that video could be a little bit overwhelming, where the one thing that sticks to you is the name of the video, PDRace. We definitely know that it was about PDRace, but what did he mention again? So all these things that we mention here, if they sound new to you, that's exactly a sign. Perfect, let's rewatch it. That's what we want to do. So PDRace is basically the foundation of everything, because we're always trading PDRace. There are always PDRace in the market. And those PDRace, they guide us towards, they give us the accuracy where we actually want to trade towards, where we can expect lower prices off of. Because for example, if we take a look at the dollar here, then if we were to use a line chart in the form of this, then we can potentially see if it wants to continue higher, continue lower, etc. But we don't really have the accuracy of where can it actually continue lower from. Yes, we somehow have swing highs as well, or somewhat, but it's not super clear. Where if we use the candle chart right there, then what do we see? All of a sudden, we get to use PDRace. Those PDRace give us that accuracy, because we're always moving lower off of PDRace, or we're moving lower or higher, sorry, off of discounted race. So that is what we're looking to use always. And again, it's not getting clustered by 1,000 PDRace, because that is not going to be beneficial, right? We want to be very accurate. And accuracy means as well that we need to limit ourselves to the PDRace we are using. Because if we have 1,000 PDRace on our chart, for example, I see people with inverse fair value gaps. I see people with new week opening gap, new day opening gap. Then what you create is basically the same as a retail, where retail, quote unquote, retail support and resistance traders. They draw random lines, what we would call, or your basic SMC guru would call random lines. And he would say, all right, look at this. We just bounce off of everything. As in, here we have support right there. Now we see perfect resistance right there. And then if we go, we have perfect resistance right there. See how we're rejecting off that line. See how we're rejecting off of these lines right there. And this is what a basic SMC guru would do, sort of to make fun of support and resistance. Where if we use 1,000 PDRace, aren't we basically doing the exact same thing? Where we are making fun of people that are drawing random lines. If we use 1,000 PDRace, aren't we also just basically drawing random lines on our chart? So that is the way I view it. And how can you truly be accurate if you have so many PDRace? That's not accuracy. I cannot be accurate if I, for example, if I want to call a market top and I am calling it constantly. Every single day, I'm trying to call this market top. And 9 out of 10 days, I'm completely wrong. And then one day I am right. Then am I accurate? No. We're not going to ignore those 9 days that I was wrong, right? So that is not accuracy. And the reason that is important to understand is because if we have 1,000 PDRace on our chart as well, then what does that create? That also creates 1,000 boundaries, 1,000 reasons to have a narrative, to create a boundary, to create a context, to have an entry pattern. So again, inaccuracy, and you could call it the lack of knowledge, is when people have a lot of PDRace on their chart. And that is not what we want to have. We want to keep it as clean as possible, as simple as possible. And that is for a reason. It's not because we can't understand those things. We understand them. We don't want to use them. That is very important. So again, those PDRace is what we went over. And then after that, we also mentioned we have a superior PDRace. Because the superior PDRace is the fair value gap. And the fair value gaps in depth is where we went over, all right, so for an order block to be valid, we basically need a fair value gap. For us to see a sweep of a swing high, swing low, or for us to say a swing high, swing low is strong, we need a fair value gap. For a breaker block, we ideally want a fair value gap. Mitigation block, we need a fair value gap. Previous day high, previous day low, they also correlate with those fair value gaps. So basically, we're always trading somehow fair value gaps, whether we are paying attention to it or not. When people mention, I have my order block here and I'm basically always trading order blocks, that order block would not be valid without your fair value gap. And that's also what they mentioned. So then my question to you is, what is really relevant right there? The order block or the fair value gap? It's the fair value gap. So the fair value gap is the superior PD ray the way I view it. Now, of course, doesn't mean that the rest of them is truly not handy. No. Otherwise, we wouldn't go over an order block, break block, mitigation block, etc. But we need to understand the fair value gaps right there. They tell us the main story. They tell us everything we need to know right there. So those fair value gaps, and by going in depth on them, that also leads to order flow, because order flow is basically fair value gaps. Or order flow is, again, those PD rays holding to one side of the market. So we first need to have that respect of PD rays, but for us to have an order flow lag, we need to create what? Fair value gaps. So without fair value gaps, there's also no order flow. Because without fair value gaps, there are also no PD rays. Because without a fair value gap, there's no order block. So there's no PD ray in itself. There's no valid PD ray. So that is very important to understand. Because then, again, we are building that story. First, we have all the PD rays. All right, we have all the PD rays that we can pay attention to. Let's define a little bit more. Fair value gaps in depth, second video. Then we have third order flow. Order flow right there is where we now use fair value gaps to determine what is order flow actually doing. Now, those first three videos, they help us already to understand bias, narrative, boundary, and target. So the analyst phase goes over, again, those first 4 foundational level, where boundary and target, so 3 and 4, is of course the same, as in it's one context. The summed up name for boundary and your target is the context. So what is the difference exactly between narrative and boundary? That is as well what we are going to go over, which leads us to number 4, context. Because order flow and fair value gap in depth, and number 3, mainly order flow leads us to a great idea of where we actually want to go higher from, where fair value gaps. So for example, if we take a look at this chart on a dollar, and we are seeing this. Let me use the replay tool really quick. We're seeing this price action right here. Then overall, we have a bias, because we understand we've just been going higher. What is the next drawn liquidity? The closest premium array. Is this swing high? So that is likely the drawn liquidity. So we have determined a bias. Why is that? Well, we are also disrespecting bearish fair value gaps. We are creating bullish fair value gaps. Quite simple. You don't need to overcomplicate that. Then we have fair value gaps in depth. Those fair value gaps right there, they lead us as well to now a narrative with that bias. So the fair value gaps in depth lead us to a bias and a narrative. But order flow in depth also leads us to now a narrative. Because if order flow wants to continue higher right here, then what is the first discount array that we are actually encountering? It's this weekly fair value gap right there. So if we want to continue higher, where can we continue higher from? That is narrative. So the narrative is purely how are we going to deliver into that drawn liquidity right there. Where the context, the 4th video comes in. Context is the area where you actually want to look to get involved before you move into the entry pattern. That's also the reason why number 4 is target before you actually get into the entry pattern. Because once we come into that, this determines right now the area where we know already where we want to look for entries. That creates context. So narrative is just basically number 3 as well, the boundary. 4 is different because 4 is not your narrative, as in your target is not your narrative, right? And your target is also not initially your drawn liquidity, because the drawn liquidity is a target on its own. It's not necessarily a context target. So where the context becomes PD ray to PD ray. And this is what you hear me mention in the previous enrollment as well, in the August enrollment quite a lot, is we are always moving from PD ray to PD ray. So context is discount array to premium array, or premium array to discount array. So in that first moment, from moving to discount array to that first premium array, and moving from the premium array to the first discount array, that is exactly the area, the small area, where order blocks will hold on the lower time frame, where fair value gaps will hold on the lower time frame, where we can look for perfect entries. So here in this case, this is the first discount array to the first premium array in the form of that high right there. Once that candle closes, it's of course the previous week high but that is where the context is. So in this area, that is your context area. As in, that is the area where you can now look for your entry pattern. After that high is taken, the context high is taken. So that is what leads to needing new context. Now, this is where also, where we understand is once we come into that context right there, we come into that discount array. After that, we have candle signs. Candle signs right there supporting the idea of continuing higher. So candle signs at this moment in time is supporting the idea of continuing higher. Where candle signs in itself, again, it leads to understanding, all right, where do we actually want to continue higher to? Or do we want to even continue higher? Are we disrespecting? Are we respecting? It allows us to read the next candle. Where on the weekly, the next candle here has the highest probability to actually continue higher because we're simply respecting that context, the discount array sitting in the Verweij gap, as in right there. So that is candle signs. And then that candle signs leads also to now targets, because the target right here is still this high as well, the previous week high. So we have added one target right there, one target, the context target in the form of that. And then this was the original target in the form of that draw liquidity right there. And afterwards, we can look for higher targets as well, where we can look for that right there. So that leads to then the targets. Then once the context is gone, it's very important that if we reach those targets, so we reach that first target, the context high, which is number 4, target, context, we reach it right there, that is when we need a new context. So when we can go into the daily time frame, for example, to look for our new daily Verweij gap to continue higher off of that. So it allows us to go down a single time frame right there to create new context to continue higher off of that. And then the cycle starts over again. And that is consistently what we're doing. And what we then arrive at is number 8, arguments. High probability versus low probability. Where this is mainly as well in a filtering process training plan where you're constantly seeing the arguments for a single trade. Are we in high probability conditions or low probability conditions? This is as well for flow training plan, don't get me wrong. If you want to make arguments for different pairs, then of course it would be a filtering process training plan. But for a flow training plan, you can still stack up the arguments. You can still see, is this high probability or low probability? Stacking up the arguments is nothing more than using the concepts and writing down everything that comes to mind. Again, I can fully understand if in the beginning that might be a little bit more difficult. But what I would love for you to do is just go into the chart and write down those arguments at first. Then eventually you don't need to write them down anymore and they just come natural. Where here, I would say, by just looking at the daily right here, I see 0 reasons to have bearish price action because I have no arguments to make right there for bearish price action. When I have no arguments for one side of the market and I can make a lot of arguments for the other side of the market. So for example, I can make all the arguments for a bullish side of the market. I can make 0 arguments for bearish price action. I cannot come to a clue on why this might be bearish. Then that is high probability. And whether that is bullish or bearish, of course, high probability, that determines on which arguments are in favor of which side. If we have more arguments in favor of the bearish side, then of course it's high probability for the bearish side. So low probability is exactly when there's not a clear winner in those arguments. So if, for example, because right here, let's first see this. Here I see a daily Verweij gap higher right there. I see an order block as well. I see that we are sort of respecting that. We likely came into that daily Verweij gap later in the day. Previous day low sweep right there. We don't have a bearish daily Verweij gap as well. We still have this clear high sitting right there, which we can continue higher to. I see no bearish arguments to be made right here on the daily time frame. Unless we have a weekly Verweij gap below it right there, but we already came into weekly Verweij gap. So if we have that right there, then I would argue, I can have one bearish reason right there, depending on when that candle also formed. Other than that, I have no bearish reasons, no bearish arguments, 0. So then eventually we just simply continue higher. And that is also understanding what are we actually doing right here. we are always looking at probabilities in the market. And what I mean by that is that we are always trying to find the highest probability, because, and again, I'm not blaming anyone, I don't want to go on a rant, but when we come into this trading industry, we have been fed a lot of lies, is what I feel like. We've been fed like the market is not random. The market is not random, you can have a 100% win rate, which the market is not random, basically saying you always can know what the market is willing to do. So basically saying you can have a 100% win rate, which no, you cannot. You cannot. And you sleep better at night if you feel like, all right, I don't need to have a 100% win rate and I can still make a crazy amount of money. You think the hedge funds out there in the world who make the most money off of trading think, oh, I need to have a 100% win rate. I need to have a 100% win rate. No, it's futile thinking. It's a little bit naive. It's a little bit stupid. And what we do want to do, what we do want to focus on is, all right, let's think of probabilities, because the market right here has two things it can do. It can either go higher or lower. Thank you, Ario. Captain Obvious. That's very clear. But how can we know which one it actually wants to do? Well, which one is simply the highest probability for it to do right now? Is it the highest probability to go higher or lower? And what is actually highest probability? Do we have bearish arguments or bullish arguments? That defines then the probability. So we're always probability seeking. We're probability seekers in that sense. That's very important to understand, because that allows us to have a clear read on price action as well. Where if we go a few ticks right there, and eventually at this moment in time, right there, yes. So at this day, on the daily time frame, what do we actually see? We have this bullish fair value gap, which we did not continue higher from just yet. All right. We came into the order block, which we also, well, we already came into it, but we did not continue higher off that as well. Then we are creating a bearish fair value gap right there as well. So at this moment in time, this of course creates what we know as a sharp turn. But what do we also have? We have 50-50 arguments. We have 50-50 probabilities. As in, we have bullish arguments and bearish arguments to be made. I can't get to a clear drawn liquidity right there. I can probably force an ID, but high probability, no, definitely not, until we get more price action. And that is, again, number 8, arguments, high probability versus low probability. Overall, these concepts, if you follow along with the videos, you already got to a top-down analysis. So the top-down analysis is just reinforcing the idea. It was basically a summary of the concepts, what we went over, how you can easily apply it as well. But the bias, narrative, boundary, and the target, the foundational levels, basically by understanding the definitions of those and then using the concepts that we go over right here, they already give you the top-down analysis. So whether you've noticed or not, and well, if you haven't, then perfect. We can go over it right here. And then you know by now that all the things we go over basically lead you already to top-down analysis. The execution already leads you to understanding entry pattern and leads you to understanding your own trading plan. So that is exactly what we went over in the analyst. And at the end, the top-down is just basically a summary of what we already went over. Now, by understanding the analyst phase and by summing up the analyst phase, we now understand and we have a great idea of where we want to actually look to trade. According to price, of course, because time we have not incorporated just yet, just simply looking at price. Now, on price, what we are looking at is, again, what is high probability versus low probability, just purely based on price alone. Then off of that, in the execution week, we start off with market structure. And that market structure is applied in a key foundational level. It's in the context. It's in the boundary and the target. So the move from the boundary to the target, the move from this discount array towards that target right there. Same what we saw on the weekly. That is where we are looking for this enrollment. For this particular enrollment, we're looking for our market structure right there. And the reason for that is because I felt like that was a little bit easier to go over in this particular enrollment. It was already quite filled with a lot of knowledge, with a lot of insights. So in other enrollments, you'll see me also use market structure where you can use it as well in your analyst phase. But for this enrollment, I went over it in the execution phase, which both are correct, of course. Nothing wrong with both of them. Then understanding market structure was more so the overall view, was the bird's eye view. Where if we dive a little bit more in depth is again where we again had that order flow, where we then look to incorporate the ST plus that RE. That led us to where to enter, where this price basically have no reason to return to. When we can find that no place to return, that is where we can then use a stop loss. Because the way we view it is we have the analyst phase. And the analyst phase is understanding where price wants to go overall and where it wants to go higher from overall. So we need to get that accuracy. We are slowly getting more accurate. Where the buy is right there, understanding if it's going higher or lower. Well, yes, you are correct. If it goes higher and you had a bullish buy, you are correct. But you're not accurate enough to actually place a trade, because to place a trade in a market, and the reason why people are not profitable as well on the technical side is because they simply lack the accuracy. Where the bias starts off with the least amount of accuracy. The narrative is a little bit more accuracy requires a little bit more accuracy, because now we need to understand, all right, we are bullish. Well, if we are bullish, then where are we actually going higher from? That's already more accurate. Then the boundary and the target overall, the context creates even more accuracy, because that tells us where we actually want to look for our entry pattern. So that is very important, because that line sets through, that accuracy line goes through into your entry pattern, because then we arrive at the third video, where to actually enter. Because when we know where to enter and where price has no reason to return to, that is where our stop loss is going to be. And that is where our entry is going to be. As traders, there's a difference between analyst and execution. And the analyst is called analyst because when you're an analyst, you have a great idea of where price likely wants to go, etc. But you're not a trader. And in order for us to be a trader, we need an execution phase. Where in the execution phase, we are simply looking where does price have no reason to return back to which lows does price have no business coming back to. And that allows us, when you understand that, and it's the basic principles of understanding a stop loss and an entry pattern, because we're always entering on places where price has no reason to come back to eventually, because that is where we expect price to take off. So that is the third video right there. Now, entry types. And entry types leads me then back to basically understanding order flow and where to enter as well. Order flow, again, simply telling us everything. It tells us so much. It tells us the fair value gaps tell us order flow, of course, and order flow itself tells us so much, because order flow right there, based relatively seen on different time frames, tells us also where we then eventually want to look for that entry. Then, when we move on from entry types to our stop loss placement, that stop loss placement also becomes a little bit more easier to understand when you understand the third video, where price has no reason to come back to. In the execution phase, if you understand the third video, where price has no reason to come back to, where to enter, then you basically understand the whole price aspect of the execution phase. Because, well, maybe not targets, but overall you understand everything right there. Because if you can, that's simply what trading is about. Where this price has no reason to come back to, that's where I enter, that's where I place my stop loss. That's it. So that leads us to then, all right, we might need to understand targets. Targets, again, is that 1 to 2 is the target of context, because we created that context to know where are we actually in, where are we actually trading in. If we go into the market blind and we look for an entry pattern everywhere, there's always going to be an entry pattern. And you'll hear me mention this a lot, that we always need a differentiator. The same for price action. Different price actions that look the same are quite similar. So which price action will actually play out? Which one is the higher probability? Well, what is the differentiator in that? It's time. Where for our targets, again, for where we actually want to look for trade, for not taking random entry patterns everywhere, that is where context comes in. So that context also leads us to number 6 video, and that is targets right there. And those targets then become very clear as well, because that is just a 1 to 2. That is, again, the target in the context, eventually the draw liquidity, etc. That also leads us to then understanding the risk management, because the risk management then needs to be according to that as well. It's according to those targets. And when we want to go break even, and that is again leads me back to basically video number 3, where to enter and where this price have no reason to return back to, because that also allows you to understand risk management. And understanding where price has no reason to come back to is understanding the time frames, and it's understanding order flow and fair value gaps. And if you understand that, then you understand where price has no reason to come back to. That is very powerful, and that is why I say fair value gaps, order flow is basically all you need, because if you understand order flow and fair value gaps, then you understand where price has no reason to return back to. You understand where it can continue higher from. You understand where it might continue lower from. You understand your risk management. You understand the 3 core videos: where to enter, fair value gaps in depth, order flow in depth, and order flow, of course. But you understand the 3 core concepts: where price has no reason to return back to, fair value gaps, and order flow. That is key. That's absolute key. Now, of course, that is all price. And what is the differentiator there? Because what is actually high probability? What is the basic market principle that we need for us to trade? It's volatility, right? We always need volatility to actually trade in the market. And volatility is seen through oftentimes when you come into the retail world, when you come into the support and resistance world, you're being told most likely, avoid news, avoid news, avoid news. It's very funny because we don't want to avoid news. We want to be there because that is the volatility in the market that allows us to ride that trend, that allows us to jump on the back of the trend and ride that wave of volatility. That's exactly what we want to do. Where the higher time frame time. So do we know on daily, for example, which daily fair value gap wants to hold, which daily fair value gap actually wants to push higher? That can be told by news. But for example, if we look at this, and I'm not sure at the economic calendar on this section right here, so you can correct me if I'm wrong, but if we had this situation right here, then that Wednesday, if that Wednesday alone only had US dollar news, then this price action wouldn't be too crazy, because you wouldn't expect Monday and Tuesday to continue higher. You would expect Wednesday to continue higher. So when you then again had that previous day low sweep to then continue higher, it's not that crazy, because that Wednesday is allowed to move higher. It's again that analogy. We have that car, and that car can go to the other side of the country. It's a beautiful car. Price action is agreeing. Do we have time agreeing? Do we have that gasoline, that fuel to support ID? At that moment in time, on that Wednesday, yes. So that Wednesday is when you then see, all right, we still are respecting the daily fair value gap, but can I still use it as a boundary? No. But that previous day low is a discount rate, is a boundary for me to look for trades off to then continue higher. So if we still want to continue higher, we can use that to then continue higher. So that is higher time frame time. Do we actually want to continue higher off of the higher time frame PD rate? Where lower time frame time is what? Do we actually want to continue higher off of the lower time frame PD rate, or continue lower, of course, off the lower time frame PD rate? And do we actually have volatility on the lower time frame right now to support the ID? Which higher time frame is then seen, all right, through news. Lower time frame is mainly seen through what we mentioned, those kill zones. Automatically right there, that led you to a trading plan eventually. Now, the trading plan right there is, of course, personal preference as well. So in the meantime and in the videos, I mentioned, all right, what do you actually want to do for your kill zones? Which time zones suit you? We're all humans, all spread out over the globe somewhere. So I can't give you one time zone. I can't tell someone from Los Angeles to always trade the London session and stay up in the middle of the night. No, we can't do that. We simply can't do that, right? Of course, makes sense. So then we need to give different opportunities right there as well. So which opportunity are you willing to take? What is your personal preference in that right there? That is the only thing that you really need to pay attention to as well. As in, yes, of course, you also need to make case studies, etc., understand the concepts, but I can't help you with that. I can't help you with choosing the time zone you want to trade. I can give you guidelines, so I can tell you from my experience how I would do it, which I've also done in the videos, but other than that, this is not something I can force you to trade a single time zone. That's really personal preference. We all have different lives. So then we arrive at the psychology. And psychology, I've not noted down the videos. It's the same for MMP because I mainly wanted to go over the first 2 weeks. in psychology, it's very important, and I think we all understood that we need to make the environment very easy for us to trade in. That analogy we used with the diet, etc. And the reason why I went over that is because I think a lot when we come into the trading industry again, and we come into the SMC world, the smart money concept world, then the first thing we do is we make the environment very hard to actually keep our psychology in check. And we sort of neglect the importance of psychology. Whilst it's being said, psychology is the most important part of your trading, etc. It's the king of all. And then nobody really pays attention to that psychology. Make it make sense. Doesn't make any sense to me. So that is where we do focus on it. That is very important to understand as well. That of course the MMP week is this exact week where we introduce trading plans, which you can use as inspiration. But eventually we will also look to, of course, go over different trading plans as well, because we have not gone over one shot, one kill just yet. We've not gone over, thank God it's Friday setups just yet, which is all things we are also going to go over. Now, this is again the end of the original enrollment month right here. And I would highly advise you after this, if it doesn't make sense at all, then maybe start off with the foundational enrollment and see if you can pick up a few things. But I would highly advise you to, even if you watch the foundational enrollment after this, then please watch this enrollment again and again and again. It's that repetition that makes beautiful things happen. It's a quote from someone who I really see as a role model. And it's, people achieve great things by doing ordinary things for extraordinary amounts of time. That is when they achieve extraordinary things. And that is a beautiful quote because that applies to everything. It's doing the basics over and over and over and over, which gives you the very special secretive award, which is just simply achieved by doing the basics over and over and over. So after this, of course, we have the finishing touch week, and where we can touch on a lot of different topics and a lot of topics that we need to maybe clear up a few things as well. And feel free to share your feedback. You can even do it through the notes section right there. If you think, all right, well, this video was not that clear to me. This video was not that clear to me. Perfect. Or maybe a recommendation of a video you haven't seen at all, of course. That is something we can go over as well. All right. Perfect. I want to thank you for your time. Thank you for your attention. Thank you for your trust. And believe me, all it takes is time. Perfect. Thank you.